Thank you for watching this video. I'm Tomoya Maruoka, CEO of ENECHANGE. As of September, I've had the privilege of assuming the role of CEO of ENECHANGE. Today, I want to explain how we plan to rebuild ENECHANGE, which we are calling ENECHANGE 2.0, and how we will set the company back on growth trajectory. In the first half of this video, I will explain the direction of ENECHANGE 2.0, and in the second half, I will cover the details of our Q2 results. Starting on September 3rd, we have launched a new management structure to lead a new growth strategy. I have assumed the role of CEO while Sogano has been appointed COO. Sogano is one of the first founding period members and led the growth of the core platform business from the inception. Given that he has deep understanding of our business and the energy industry in Japan, we believe he's the best suited for the COO role to recover ENECHANGE. Under the new management, ENECHANGE 2.0 aims to strengthen ENECHANGE 1.0 and achieve further growth and profitability in FY25. There are two key points in these slides. The first point is our two-tiered growth strategy, in which we ensure the growth of our core business as the first tier, and while pursuing the growth in the EV segment as the second tier. Over the past 2 years, we have focused heavily on EVs in terms of investor communication, management's attention, and company resource allocation. I believe we have successfully established the EV charging business, but during those 2 years, the resources and mindset share allocated to the platform business and data business have decreased. So rebuilding the growth strategy around the core business is the first key point. Of course, continued growth in the EVs is also essential for the two-tiered growth strategy. The second key point is that we set a target of achieving ordinary profit in FY25. So this slide shows the strategy house for ENECHANGE 2.0. As mentioned earlier, it is a two-tiered design. Also, this slide lists the key focuses and major levers. The first tier is core growth for platform and data. Here, our focus is balancing profitability and high growth rates. Since these two businesses are already profitable, the focus will be on how to maintain high growth rate while being mindful of profitability and cost efficiency. The key levers to achieve it are organic growth and nonlinear growth, such as M&A. The second tier is the further growth of the EV charging business. We continue to position EV charging business as a further growth engine. The focus here is investment in the EV charging business at the accelerating speed to secure the future recurring revenue. Also, the focus will be improving the profitability of this business. The main lever for the second tier is considering a flexible approach to accelerate EV charging business. One idea is the use of external capital, such as partnership with other companies who want to participate in this industry. Not only relying on the external capital, we are fully aware that our effort to improve the profitability through cost efficiency is required. So this is an overarching lever for the first and second tier. At the bottom of the slide, we list the 4 enablers for the ENECHANGE 2.0. I'd like to highlight 2 particular important points. The first is the effective governance and robust internal controls. Given the recent accounting issue, we now fully recognize that improving enterprise value cannot be achieved without proper governance and internal controls. The second key enabler is strategic capital allocation. The management team is currently strongly focusing on strengthening our financial foundation, which we will deep dive into later. The slide illustrates how we envision ENECHANGE 2.0 in 3 phases. The first 30 days, starting from the end of July, when we announced the new management structure, is the inception phase. Next is a 100-day plan for change. Then finally, we enter the growth maximization phase. We plan to provide a more detailed growth plan for the second round of growth document, in which we will explain how we aim to expand our core business and EV charging business. At this stage, we are presenting a high-level direction of ENECHANGE 2.0 today. I will explain key updates in the inception phase in the next few slides. But before that, I'd like to share my personal thoughts and reflections after the first 30 days. For me, the first 30 days were positioned as a phase to listen to employees' opinion. I had discussions with about 30 members from department managers and above to hear their thoughts on how they wanted to shape the company going forward. One of the strengths of being a venture company is that many employees are excited about creating a new company and see this as a second founding moment. The enthusiasm within the company to build the new ENECHANGE 2.0 is very high, and I am personally very pleased with this. So now I'll deep dive into key 3 updates in the inception phase. First progress is publishing the prevent measures on July 29th. As shown in the middle of the slide, we announced 6 specific measures. One of the key measures is the first one, clarifying responsibility. As the result of clarifying responsibility, we formed a new management team. Under the new management, led by me, Sogano, CEO, and Hirata, Chairman. While Hirata, Chairman, will be strongly involved in the defense measures, Sogano and I will lead the growth plan moving forward. Hirata, Chairman, has experience serving as a CFO at Toshiba, where he contributed significantly to the company's recovery from the management crisis in 2015. We believe he is well suited for strengthening internal controls and governance in our company. Regarding the prevention measures, we are currently planning actions for the 6 main measures. Simply documenting the measures is not enough. So as a company, we're committed to take actions. The second deep dive of the first 30 days is strengthening our financial foundation. As we mentioned in the ENECHANGE 2.0 strategy house, reinforcing the financial base is a crucial enabler. We have begun the evaluation of options in the first 30 days. This slide shows the reason why we need to tackle this financial foundation issue. The graph shows the company's net assets were at 2.2 billion at the end of March. But due to the impact of the Q2 financial result, it decreased to 800 million yen. Looking ahead from Q3 through Q5, while the deficit of EV charging business will be smaller thanks to the cash inflow from the subsidies, we anticipate further decrease in net assets by the end of FY2024. Hence, as a new management, we recognize strengthening the financial base as one of the most important priority for our new management. The third update of the first 30 days is securing bridge loans for the EV charging business. The bridge loan is crucial for the EV charging business. Because we have a relatively large amount of initial cash outflow for equipment purchases and construction. Then later, we will get the partial cash return through subsidies. So the bridge loan, which covers the period between the cash out and the subsidy inflow, is very essential to the business. In the first 30 days, we had multiple discussions with SMBC and Aozora Bank, and as of September 27th, we are pleased to announce that the commitment line for the bridge loan will be contracted on September 30th. This was a very, very important step we made in the first 30 days period. Lastly, here is key milestones of ENECHANGE 2.0 investor communication. Next disclosure will be around mid-November for the Q2 result. Another milestone will be second edition of growth potential material, in which we will update you about the progress of our 100-day plan. During this crucial period, we intend to report the progress of our 100-day plan with a high transparency to our investors. From now on, we will deep dive into financial results for FY2024Q2. In the first half of the FY24, the platform business and data business recorded their highest ever sales and highest ever recurring revenue. For the EV charging business, we have started to generate charging revenue. Although the amount is still not so large, the business is progressing steadily. The underlying KPI also showed very positive progress. In platform business, number of users grew strongly to 627,000 users, as well as ARPU grew at 10% year-on-year. Data business also had a strong growth in recurring revenue ARPU, which is led by upsell and cross-sell. For charging business, the charging time per unit is progressing, reaching 16 hours per month in Q2. And if you look at the data in August, this leads to 21 hours per month. We believe we are delivering very strong performance within the industry, actually one of the best in the industry. If you look at the number of installed stations, the growth during this quarter was small because the installation is skewed towards the second half of the year due to the timing of the subsidies. However, the progress of the subsidy process is on track for our target. Looking at the half-year result, platform and data business achieved record high sales for the first half of the year. Operating profit combining the platform and data business, which we call core business, exceeded 250 million yen and continue to perform at the high levels. However, the EV charging business recorded an operating loss due to the upfront cost for business expansion. Looking at the future, although we are projecting a loss for FY24, we are aiming for profitability in FY25, as we discussed in ENECHANGE 2.0 Strategy House. Also, this slide provides forecast for each quarter, whether ordinary profit will be in deficit or profit. As you can see, the platform and data business will be profitable throughout the year. However, in EV charging business, we expect profitability in Q5 due to the receipt of subsidy, but we are projecting an overall loss for the total of 15 months. From here, I'll deep dive on each business. For the platform business, sales for the first half of the year hit a record high, and operating profit was approximately 130 million yen, which is also at the high level. The growth of the platform business is coming from two factors: the growth in the number of users and ARPU. The number of users has reached to 627,000, showing a very strong growth of 24% year-on-year. The key ARPU for recurring revenue has increased by 10% year-on-year, reflecting the impact of rising electricity price. ARPU for non-core, non-recurring also grew at 41% year-on-year as a result of strong customer acquisition activities by energy companies. Looking at the business environment, JPEGs have remained stable compared to 2022. As a result, the share of power sales by new entrants rebounded in June 2023. After the reversal in June 2023, customer acquisition activities by the new entrants become more active, which expect a positive impact on our non-recurring revenue and our future recurring revenue. This chart illustrates the growth potential of platform business. Last year, we anticipate the potential growth at 6 billion yen by 2027 in the last year growth document. Now we adjusted that to 7 billion yen by 2027, reflecting the current ARPU levels. Moving forward, we plan to provide a more detailed growth plan in the second round of the growth potential document. So at this stage, we keep this document at high level. Next is data business. The data business, like the platform business, has also shown very steady progress. Q2 sales was approximately 290 million yen, a record high revenue, and operating profit also remained at a high level. The key driver of the strong performance in the data business is recurring ARPU. The recurring ARPU increased by 32% year-on-year, showing a very steady progress. The main factor behind this growth is the cross-selling and upselling efforts within the data business. In terms of the business environment, the performance of major electric companies have been very strong. This has been reflected in expanding IT budgets, as these power companies expand the investment in IT and software for GX and DX, which are our focuses. We understand the business environment for our data business is improving. Under the such tailwind business environment, we are continuing the development of GX solutions. One example is the e-value platform, which was announced in this year, June. This platform is aligned with the United Nations initiative, the 24/7 Compact, which enables customers to manage and much of environmental value on 30-minute basis. As you can see on the right side of the chart, we developed an energy bill situation system for Mitsubishi Electric. This simulation system has originally been used in the platform business for the electricity switching service, as well as being provided as a marketing tool to energy companies. But this time we created this simulation system for the promoting the Mitsubishi Electric all-electric system, which shows that we are reaching a broader customer base. Next, we are looking at the EV charging business. Regarding the EV charging business, we have changed our accounting treatment of the SPC. We changed from non-consolidation basis to consolidation base. Due to the impact of SPC consolidation, the revenue and profit structure of the EV charging business has been changed. As you can see in the left side of the chart, in the non-consolidated basis, the non-recurring revenue was predominant, which was mainly the sales of charging equipment and construction to the SPC. Going forward, we move to the right side of the chart. As you can see, the business record expense and capex for the infrastructure in the beginning. Then we receive the partial reimbursement from the subsidies. However, at this point, we are still deficit. So the future recurring revenue will offset the rest of the cost eventually. Given this transition, recurring revenue, which coming from charging time, got even more important for our new business model. As a result of the consolidation of SPC, we have two issues in EV charging business in the financial report. First one is going concern notes, and second is impairment losses of the EV charging business. We identified 4 solutions to address these issues. I'd like to highlight the second point of the solution, securing debt financing. We understand that this would be a direct measure to solve this impairment losses. So in light of our great news of bridge loan to be contracted on September 30th, we are continuing discussions with our new accounting auditor on how to solve this impairment losses as a first step of solving these 2 issues. From here, I'm going to explain the progress of the EV charging business. The number of the installations of the charging has been flat due to the subsidy timing, as we discussed earlier. However, I'd like to emphasize that we have already begun receiving a review result for the key subsidy application windows, and the progress is on track to achieve the plan. So we expect to install a lot more in the second half of the year. As we explained earlier, with the consolidation of the SPC, charging time has become a critical factor, even more critical for us. In Q2 of FY24, the charging hour was 16 hours per month, but in August, this had increased to 21 hours per month, reflecting the summer holiday season. We believe that this is one of the strongest performances in Japan, but at the same time, we see much more room to grow in the future, comparing it to US market, which has already reached to the 72 hours per month, for example. Looking at the business environment, the slide on the left side shows a graph showing the proportion of new EV and new PHEV car sales in Japan. As of Q2, the rate is 2.4%, showing the slight weakness in the market. We understand that the reason for this is the lack of the new EV model being released. However, as various OEMs announced, new EV models will be released around 2026 to 27, hence we expect this rate to rise again. Additionally, based on the discussion within industry experts, we believe there would be a unique EV growth path in Japan, in which the first main EVs penetrating in Japanese market would be a small K EV or PHEV, which has only 20 to 30 kilowatt-hour battery. For those small EV batteries, our 6 kilowatt normal charging station could charge roughly half just for 2 hours. This suggests that the normal charging infrastructure, which we are mainly focusing on, would be even more essential for the unique Japanese EV market. Hence, we continue to see great opportunities in this area. Lastly, we have 3 phases slide again. As we discussed until now, our underlying business shows quite strong momentum, especially in the core business. Now we are in the middle of 100-day plan. We have key initiatives for this 100-day period, and we will make sure that we'll have a great progress on those, and we'll communicate it with a high transparency. So thank you for support to the company's transition to ENECHANGE 2.0. I look forward to having the next update. Thank you for watching this video.